IRAs. What's an IRA? Let's talk about IRAs. An IRA is an individual retirement account. It's a financial account with tax features that help individuals save for retirement. Now there's a traditional IRA, and then there's also what's called a Roth IRA. Now these are the two major types. There are other ones which I'll touch on later, but this presentation basically talks about these two types because this is what covers most of the population and what concerns most of us. So the traditional IRA allows for tax-deferred growth, and there is a tax deduction with limits which we need to consider, while a Roth IRA offers tax-free growth. Now it's not tax deductible, but it does have that tax-free growth element, which is very attractive. So a traditional IRA in 2019 lets you contribute up to $6,000 or $7,000 if you're over the age of 50. And it's the same thing with the Roth IRA, $6,000 or $7,000 if you're over the age of 50. So the traditional IRA offers the tax deductibility, but it is phased out based on your modified adjusted gross income, or MAGI, whatever you want to call it, if your workplace already has a defined retirement plan, such as a 401k or things like that. The Roth IRA, your total contribution can be phased out based on your modified adjusted income amount. The deduction phase out for singles is between $64,000 and $74,000 of adjusted gross income. Basically what that says is once you hit that $64,000 income level, then the amount that you're going to be able to deduct from your taxes for the traditional IRA, the tax deductibility element, is going to be reduced a little bit until you hit that $74,000 threshold, and then it's not deductible at all for you. And then for married filing jointly, the amount is $103,000 to $123,000, and that's the phase out. Now on the Roth IRA, the contribution phase out for a single person is $122,000 in income. So again, you can contribute up to the $6,000 limit up into an income level of $122,000, but if you make over $122,000, then the amount that you can contribute is reduced. So that $6,000 would be reduced to $5,000 if you make a little bit over $122,000. And if you make $130,000, then you may be able to contribute, let's say, $1,000 instead of $6,000, because they really phase you out. And if you make over $131,000, then you can't contribute at all to a Roth IRA. None of the $6,000 is available, although there is a backdoor Roth IRA option that you could take. And then for married filing jointly, the phase out is between $193,000 and $203,000. So again, if you're under those limits, you can contribute the full $6,000 that is available. Otherwise, that $6,000 is reduced by a certain dollar amount once you hit these thresholds. And that's what you need to understand.
This content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. The content is for information of a general nature and does not address the circumstances of any particular individual or entity.
For a traditional IRA, let's make some assumptions here. Let's say your income was $64,000. So if you did not take a traditional IRA contribution deduction, your adjusted gross income would remain at $64,000. And given tax rates for 2019, I believe the taxes due on that $64,000 would be about $9,939. Now, if you decide to withhold $6,000 or some amount or deduct it from your income because you want to participate in a traditional IRA that is deductible, then your $64,000 income will be reduced by the $6,000 contribution you make, or whatever the amount is, which will leave you with an adjusted gross income of $58,000. And that $58,000 would be then subject to tax. Your taxes due on that would be about $8,619, which means because you made that contribution to a deductible traditional IRA, you lowered your tax bill by $1,320. So you're paying less to Uncle Sam, and he's allowing you to invest that amount of money in some sort of income generating vehicle for your retirement. On the other hand, because it's a tax deduction, it really is a tax deferral. So that $6,000 and anything that is to be made on it over the years in income will be taxed later on in your life as income. So keep that in mind. If you don't pay now, you're going to pay later. That's always the case, right? The deduction phase out does start at $64,000 in 2019, but just because you make more than that doesn't mean you can't participate in the IRA to the fullest. even if only part of your IRA contribution qualifies for the traditional tax-deductible type. Let's say in this case, let's say you're only able to deduct $3,000 from your taxable income as part of a traditional IRA contribution. You can still put in another $3,000 into a Roth IRA because you do have that $6,000 total allowable to you, or $7,000 if you're over the age of 50. So you can still participate to the fullest in both regards. So again, the traditional IRA offers you tax-deferred growth, but it will be taxed when you take it out. And there are limits as to what you can put in. Whereas the Roth IRA, tax-free growth, tax-free when you take it out, and it is not tax-deductible though on the front end. So with the traditional IRA, like I said, it is taxed as income when it is withdrawn later in life. Now, you cannot withdraw it until you're at age 59 and a half, or else you will have to pay a penalty as well as income taxes on that amount. And you are forced to start taking withdrawals at the age of 70 and a half. Whereas on the Roth IRA, it's tax-free when you withdraw it, although you still have to be age 59 and a half to avoid penalties. You can withdraw your original contributions at any time tax-free, so that's a bonus. But you must wait until 59 and a half on gains or pay taxes plus the penalty. The good thing is there's no mandatory withdrawal age, so you don't have to withdraw from your Roth IRA at age 70 and a half like you do with your traditional IRA. So from an income tax standpoint, is there really a difference between investing in a traditional IRA versus a Roth IRA? Let's take a look at some numbers. Let's say you have $1,000 worth of income that you can put into a traditional IRA account, or $1,000 worth of income which you can invest into a Roth IRA account. Let's assume the current tax rate due on any income for you is 25%. So if you decide to put $1,000 into a traditional deductible IRA account, you will not be taxed on that $1,000. It's tax deferred. Whereas in a Roth, since it's an after-tax investment vehicle, that $1,000 worth of income would be taxed at 25%, which would leave you $750 to put into your Roth account. Let's say today you can either put $1,000 into your traditional IRA or $750 into a Roth. Let's assume over 30 years, both of those accounts will grow at a 7% compounded average rate of growth. And at the end of 30 years, in your traditional IRA, you would have $7,612. Whereas in your Roth, having invested only $750, you would have $5,709 in that account. However, on your traditional deductible IRA, you still owe income taxes on that. So at the end of 30 years, let's say you decide to take it out of your account, you're going to owe 25% if that's the tax rate at that time still. That tax will be $1,903 taken out of your $7,612, which would leave you $5,709 of net funds available. Whereas in your Roth, your $5,709 in your account is not taxable. There's no tax due. So your net proceeds are $5,709. You'll see they are equal at the end of 30 years. That's assuming that the tax rate did not change between when you put it in and when you took it out. Now, if your taxes are higher in the future, then obviously this amount, this 1903, is going to be higher, which is going to lower your net funds available, which will then make this number lower than your 5709 over here. So whether or not to choose one or the other, or one over the other, is really based on what you think your future tax rate is going to be. If you think your taxes are going to be higher in the future, then you may want to pay your taxes now via a Roth so that when you do hit the future, your income and all the interest you've earned on your investments are tax-free. So those are the key things to remember. So really, from a tax standpoint, if your taxes are the same now and later, there's no difference in terms of what you're going to net out. But if your taxes are higher in the future, your Roth IRA is going to work out better. If your taxes are lower in the future, which I guess could happen, then your traditional deductible IRA will actually be a more favorable investment. So that's what you really need to keep in mind and think about when you're choosing between the two, if you need to choose between the two. So one thing I want to add is that contributions for any given year can be made as late as April 15th of the following year. So for instance, your 2019 contribution can be made as late as April 15th of the year 2020. So that's a cool feature. So I've been discussing the two most common types of IRA accounts, the traditional versus the Roth IRA. It's important to note that there are some other versions of the IRA out there. I just want to touch base on them. Under the umbrella of a traditional IRA nomenclature, not only is there a deductible version, which I've been talking about, but there's also a non-deductible version, which obviously means it's not deductible from your taxes, so it does not give you any tax shelter. There's no reason to put money into this one except for certain cases, because the Roth IRA allows you to dump your extra available balance that you can put into an IRA account into it. So I would say deductible first, Roth IRA second, and then you can also make contributions to non-deductible. There are certain cases, but you can explore that further on. Unless you run into your income limits and you cannot deduct and you cannot qualify for a Roth IRA, then the non-deductible IRA contribution makes sense. And I can touch on that in another video, or you could do some research on the internet and find out about what they would call a backdoor Roth IRA. There's also things called SEPs and Simples for small businesses and the self-employed. Not really within the scope of what I want to talk about, but those are some options that you can explore. And then you may have heard of IRA rollovers. That's just basically taking a 401k plan fund that you have at an employer, and when you leave that employer, you have an option of taking those funds and rolling it into an IRA account. And then you can either make that just a traditional IRA account, or you can convert it into a Roth by paying taxes on the amount in that account. And that's out of the scope of what I want to talk about today as well. But you can always look up more information on those, or I may cover them in a future video. We'll see. Now your head may be spinning from all that information. I hope not. I hope I was able to educate you on some level as to the benefits and drawbacks of both accounts. Really, IRAs are great things to have, and I really like the Roth IRA because of its tax-free nature later on in life. And I would recommend that you get into an IRA of some sort, whether it's a traditional deductible or a Roth IRA. Start saving money. They're easy accounts to open. You could do it at any brokerage, and you can do it for no fees or very low fees. So I encourage you to do that. If you have any other questions, please let me know. Go ahead and write some comments down below. Tell me if you already have a Roth IRA or a traditional IRA open, or what your plans are, or what questions you might have, and maybe I can answer them for you. If you like this video, I'll keep making more videos. Hopefully you can subscribe if you like to see my content, and I hope I can entertain as well as inform. Let's not be fools with our money, but let's be smart, and let's get rich. But anyway, have a great day.